on to the next part, I'd like to first start by welcoming Shannon Robnett, founder of Shannon Robnett Industries, to the stage. Woo.
Thanks, Adam.
Wonderful. Please have. All right, I'll start with the bio, and then we're gonna have some fun today. All right, so with over 25 years of experience, Shannon has been involved from start to finish on over 350 million in construction projects such as multifamily, professional office buildings to city halls, fire and police stations, schools, industrial, and mini storage. Along with his knowledgeable team at Shannon Robnett Industries, Shannon is dedicated to sharing his expertise and delivering top quality projects that bring in numerous passive income streams to his syndicate partners. And Shannon, when I was kind of doing my research on you, I also learned about Robnett's Real Estate Rundown that has 107 5-star ratings on Apple Podcasts, and he's done 323 as of yesterday episodes. So big clap for that, 323 episodes.
Thank you, Adam.
And it's a great show. Like I definitely recommend seeing it. And we're going to do a bunch of different social media and promo and things like that after. So for everybody that's not following Mission Matters Media on LinkedIn, follow it. You're going to see all of this content. You'll see pictures of yourselves, I'm sure, on that as well. So definitely follow that, and more to come there. And we're definitely going to be plugging the podcast. All right, so the topic and what I mean, even though you work in many different industries, different parts of commercial real estate, what I really want to talk about today is the industrial warehouse space. I guess just to get us kicked off here, tell us a little bit about your background and maybe what led you to that.
Well, I grew up in a real estate family, so I'm a second-generation builder developer. I'm a fourth-generation realtor. And I watched my parents build a very simple cash flow stream way before Rich Dad Poor Dad came out. That was a book I read when I was 20, when it first came out. But I watched them just build something that everybody needed to start their businesses. They were the incubator space for a small company called bodybuilding.com. Another couple of companies that were part of subsidiaries of Hewlett Packard. And I watched them create something that allowed them to live their life, protect as a hedge against inflation, and retire at 50 with cash flow. So to me, it seemed pretty simple that as I began to build my career, I also followed that same trajectory where we built a business that built buildings, and then from that became investors in those projects ourselves.
What attracts you to that space versus maybe some other niches?
Well, we're active in multifamily. We've done value-add office. We've done a lot of things, but the thing that I really love about the industrial warehouse space is that it's truly a triple net lease. So, especially in inflationary times when you're seeing insurance costs go up, you're seeing, the cost of mortgage changes, all those kinds of things that factor into that. None of that is an expense to the landlord. Right? So when the insurance triples in a year, or in a lot of cases it has gone up 60% this year, you're hedged from that because that is an assignment of that lease to the tenants. So your initial lease is your initial cash flow, and it will remain that way. And that's really kind of the beauty of that space because you're protected.
So let's talk a little bit about how in a recession or COVID and all these other things, like how was that particular sector affected?
Well, somebody mentioned it earlier today that there are more businesses historically started during recession than any other time in history. My first building, I had a company that makes gelato ice cream. That was back in 2001. The businesses have sold 3 times, but they're still my tenant, right? So when you're going into a recessionary period where things are getting more expensive, costs are going up, but you're able to hedge against that with a triple net style lease, and more businesses are being started during that time period in history, it seems to me to be a logical choice. It's not an asset class that fluctuates as much as we've seen multifamily do, and it also trades at a higher cap rate. So all of those things will allow the investor to reap a better reward in a more stable asset than something that fluctuates as rapidly, expands and contracts as much as we've seen multifamily do in the last couple of years.
Talk to me a little bit about the adaptability of the properties and of the real estate.
Well, I mean, we've had everything from doggy daycares to gelato ice cream to VR centers. Office has gone in there, warehouse obviously, but really the space itself is designed as a large open space with very minimal TIs. I was in one of my buildings, I want to say a couple days ago, but it was probably literally first of the year. And time flies when you're this old, right? But the reality is, I went in there and the tenant had put new flooring in and had repainted his office, and I said, hey, did you get landlord approval for that? And the tenant chuckled and he said, why would I want to pay 15% more than it cost me to do it? Plus I'd have to do it on a weekday instead of a weekend, which worked for me. And we both kind of laughed, but the reality is most of my tenants are happy with their improvements. They stay for 10 or 15 years. I don't have the turnover. And then when I do change it, most tenants look at it and go, yeah, I need a couple of offices and a bathroom, which is already there. And they're willing to look at it and go, I want to get into starting a business right now. I'm okay with what's there, just put a coat of paint on it. So it's a very easy asset class to manage, and it's usually very low impact on tenant improvements and other things like that.
What geography do you operate in? Like,
we're from Washington to Florida, so we've got a deal going in Florida right now with an international stone dealer. We're selling an asset out in Washington right now. We're looking at the Raleigh-Durham area, which is a very hot tech center with a lot of need for industrial space. We're doing deals in Tennessee. We're also in the Texas market, so we're all over the place.
Can you give us a look behind kind of the investment thesis and what goes into making a decision to acquire a property?
You know, the first thing that we look at, Adam, is we look at the market. Before I'll ever look at a deal, I have to know that I have a good market. I would rather take a mediocre deal in a hot market, in a strong market, than a great deal in a mediocre market, because, you know, rising tide floats all boats. And when I have the ability to take advantage of market conditions that are beyond my control, rather than just being at the whim of what my property can do in the area, I'm going to have a lot more statistical success. And then when I've looked at that, I like to drill into it and say, okay, you know, we've invested in the Houston market. Median income in Houston is about $60,000. It's a blue-collar town. That's great for industrial. You look at the liveliness of the port, but it's not really a great market for multifamily, especially on the development side, because you're going to be pushing rents. And when you take 30% of $60,000, it doesn't afford a new apartment, right? So we look at other areas that are growing like that. Raleigh-Durham has got some great growth going on. Nashville's got some great growth going on as far as wages. So we really look at markets first, and then from there we can decide, so that we don't get shiny object syndrome and we're looking at 95 different markets all over the nation. We can really decide on if that market works for us, and if so, what asset class, and then from there we can pursue deals in that area.
So going along that same line of thought just a little bit further, what's attractive to you right now? Like, what are you looking at in the market?
You know, we've got several development deals going. Like you said, I've been doing this for 27 years. So when everybody talks about interest rates going up, I keep asking, up to what? You mean back to normal, right? And so I get that, but we've always underwritten to an 8 cap. Anything that we build is built to an 8 cap, right? So when market conditions change, we're seeing our profits maybe return back to spreadsheet, but they're not going past that. So when we're looking at assets, we are still finding deal flow. We're still finding development deals where people have understood that this is the value of their project, this is the value of the land, these are the building costs, these are the finance costs, they still fit in our model. So we're still able to take advantage of those, but we're not chasing deals. We're not trying to do a deal just to get it done, just to get the acquisition fees, just to get the assets under management. We're looking at a cycle that in development is, you know, 16 to 30 months long at a minimum. And so we have a little bit broader horizon, we have a little bit higher threshold. So we're still finding deal flow, but we are having to work a little harder for it.
Oh yeah. Any nuances to the financing?
You know, one of the things that's interesting about commercial finance is it's not necessarily so much based on your balance sheet, but your resume has a lot to do with that. And, you know, again, 27 years in the industry has allowed me to put together a resume that banks like to see. I've got the experience, I built it, I've saved it, you know, I've done a lot of different things with assets, and so when they look at that, we have a very strong presence in that field because of the background that we have. On top of that, they like to see liquidity, they like to see, you know, partnership structure, they like to see repeated exits. We've got all of those in spades, and so we're able to really put forward a strong foot that says, hey, we've done this, we know what we're doing, we're able to do that not only for banking, but for our investment partners as well. And so that part really kind of plays out. It only took me 27 years to get here.
So this question is specifically for our YouTube audience. Thinking about somebody that's just kind of, maybe there's some investors out there that have only primarily in the past invested in residential real estate, or maybe they've kind of thought about office space, but they haven't really thought about this warehouse or industrial warehouse space. Like where does one start as they kind of start going down that path and thinking about allocating capital?
Well, I think every investor needs to start with what is their investment thesis, right? What is their goal and their objective? And in my opinion, there are three different types of investors. There's those that are investing for tax advantages, there's those that are investing for appreciation, and there's those that are investing for cash flow. On the industrial spectrum, industrial is a very safe asset. Right now it's currently trading at about a 6 to a 6.5 cap, where multifamily is still trading, mid-4s. So your return on cash is higher in that regard, so it's a great cash flow asset. It's also dealing with tenants that have a 3 to 5 to 10-year window on their lease, and so you've got a lot more capture time there. It's a lot more stable, where you don't have tenants turning over, hundreds of tenants turning over annually. How many are you going to retain? Are we going to get rent raises? Those are all built in. So this really, this asset class really applies to people that are looking for tax advantages through depreciation and through for cash flow. So those two are really the investor that we're looking for. So if that's kind of your thesis and what you're looking at, then you can begin to explore and dip your toe in the water of what is the reason you would want this, right? Are you wanting to get with an operator that's doing a value add, that's hoping to push rents, or are you wanting a known factor with signed leases, cash flow that's coming in a asset that is run by business people for business people? So it really kind of comes down to what are you looking for with your investment returns.
So shifting slightly to maybe a little bit of the entrepreneurial bent, you've been in the business a long time, been successful, multi-generational, real estate family, as you mentioned. What do you think are some of the reasons for your success and your longevity in the industry?
Well, I think longevity in the industry comes from continuing to do it, right? I mean, there's a lot of people that have been in real estate for a couple of years. There's a lot of people that were in tech before that. They were in, advertising before that. And I think that, the biggest thing that I've experienced is that real estate is really, it's cyclical, right? And so if you've lived through the cycle and you're still there, you've got a really good chance of having an 80% crystal ball on what the next cycle is going to be with a different flavor, right? So we went through the downturn of '08, then we walked into COVID, then we walked into, who knows what's coming next. But the reality is real estate is a long game, and if you're playing a short game, you're probably going to wind up in trouble. But when you're looking at that 5, 10, 15, 20-year horizon, you're going to wind up being wildly successful in the game, but you've got to stay in the game. You've got to make it your mission to be there tomorrow and be there in 5 years and be there in 10 years. And it's definitely not a get-rich-quick, but it is an opportunity for most people to retire on cash flow that is literally showing up in your mailbox.
You mentioned earlier, and I know one of our previous panelists mentioned as well, the idea that during a recession, a lot of new businesses start. So again, along the entrepreneurial bent, is there anything that sticks out, any business or thing that sticks out to you, maybe something that we can kind of wrap our head around, maybe a business that did start during a recession?
Well, there are a lot of businesses. Google started during a recession, right? And there are a lot of people that are coming out. Not everybody is in the doom and gloom department of what's going on right now. We are not in necessarily a bad economy. We're in a spenders tightening their belt economy, other things like that. And as tech companies and wholesale companies and retail companies begin to lay people off, those people are going to have options. They're going to have the ability to pursue the American dream. They're going to be able to be more mobile than they were in the past with job placement, work from home environments, and they're going to be able to pursue that passion. And a lot of them still have money in retirement accounts and savings because of the last economic boom that we've had. And so I think there's a lot of opportunity for people to get involved in startup companies that are going to then need more warehouse space, so that helps me, right?
Yeah.
So the reality is the more that you can look at what our economy needs as things change from a go to the office, work 9 to 5 type of an economy to one that can be mobile, that can do what they do from Bali or Antarctica for that matter, you're going to be able to see opportunities for businesses that are not centrally located but have a central business presence. And that's where I think the industrial marketplace will really remain strong, because there will need to be that central hub for distribution and or tech and or just your general business presence that that particular asset class will provide.
So for the audience, I'm going to definitely open up to questions in a moment or two, but any projects that you, so get your ideas ready, your questions ready, because it can be about obviously warehouse, industrial, multifamily, and I think you can probably throw anything, Shannon. He's probably got it covered, right?
I've probably done it once.
I thought so. So any projects that you're working on right now that you care to talk about or highlight?
We've got a warehouse project that we're getting ready to start in Florida that is for Constantino Stone. We've got a 10-year lease with them. They're leasing 40,000 square feet from us with the ability to add an additional 30,000 square feet. We've got an apartment complex we're getting ready to start just outside of Nashville, and then we've got a couple other projects in the pipeline. But we always have deal flow. That's 27 years of contacts. I get a lot of information from a lot of different sources, and we've always got things that people can be a part of.
Awesome. Strag, if we want to maybe open it up to the floor.
Thanks for all the great info. I was actually just going to ask you, since you are all over the country right now for multi-unit, what's like the better market to go into right now for cash flows?
As far as the industrial space, that is market dependent, but what we like I said, is we like strong markets that produce a lot of job growth. So we're very bullish on Nashville, Tennessee. Raleigh's got a lot of job growth. Houston, the port has reopened with very strong fashion, especially with what happened down here during COVID in Los Angeles. So we've seen a lot of really strong markets that really have growth. And when we look at growth, we're looking at new people moving into an area, not necessarily revitalization, because then you're recycling the same stuff. And when a market is growing, you've got people that are coming from outside areas. California is a great export market, right? You guys export more people than you do anything else. But one of the things that you guys do is you bring people with higher expectations of price point, higher expectation of what the asset should cost, and so that's great for raising rents. And so we're looking at one of the main economic indicators is where are Californians moving. Texas is a great market for that because there's a shortage. Supply and demand always plays into that. So those are some of the factors that we're looking at.
The zip is 90057.
You said you're doing an industrial deal in Florida. How are you looking at the insurance risk?
No, my wife has an account of her.
So the insurance,
It may be
Last name, last name.
The insurance market in general.
so the question was, we're doing an industrial deal in Florida. How are we addressing issues like insurance? And that's one of the amazing things about industrial, because it's a triple net product, we are not responsible for that insurance, okay? So when insurers came out this last year and raised everybody's insurance rates by 50%, that was an expense to our tenant, right? We pay that, but we collect that in a triple net paid every month. And so that's truly an expense of the tenant, which is another reason why we love industrial in Houston and in Florida, because they're very volatile, these things called hurricanes or freezing or things like that. But those are our expenses, and so that's really one of the main reasons why we love that market with a triple net lease.
All right, so we will, first off, let's all thank you. Appreciate you coming on.
Thanks, Shannon.
I know, Shannon, thank you.